Infinite banking obviously made a lot of sense to her. So this is what we did. So we did a policy and it was about a 50,000 per year premium. Now keep in mind, these premiums, whether they're large or small to you, they're just examples. Your numbers are your numbers. So just keep that in mind. And so what we did on this, we put in 50,000 per year and she has some flexibility in that premium. She doesn't have to put in that much if she doesn't want to. And about 70% of that was going towards the cash value. So very quick cash value growth. After about 3 years, she had about 115,000 of available cash value. And that was at the beginning, I believe, of year three, maybe a bit more. Hey, everybody. Once again, welcome to another Founding Fathers, and I'm Brian Fout. So in this presentation, we're going to be talking about how real people are using infinite banking. I do got quite a few different case studies, about actually 9 different ones that are from clients that I've worked with that we can go through. I'll go through a handful of them, and if we want to go through more, we can always do that. Infinite banking. So let's kind of go through the case studies. Now, most of you, if you've been watching Jason, been watching some of our content, you understand infinite banking at a core level of what it does. But so these are some clients that I've personally worked with one-on-one, done some stuff with, and this is what they've accomplished. So in this first example, I want to go through a business owner and how this business owner is buying equipment without loans. So this is Mike. And so Mike, he owns a mid-sized construction company in the Midwest, doing about 1.2 million of gross revenue, so before taxes, all that kind of stuff. And his big concern that he had with his business was that he didn't want to use traditional banks. He'd been using them and it did not like them. And he wanted to have more control of his cash flow. He wanted to keep cash flow going through the growth phases as he grew his business and didn't really know what to do because the banks weren't helping him with that. He wanted to buy a new excavator and a service truck. So he wanted to grow that. The total cost of just those two things right there was $120,000, quite a bit. And his bank was offering him financing, construction financing, for about 8% over 5 years. Required a lot of documentation. They wanted a lot of collateral, so personal guarantees and business guarantees on that. They wanted to lean the business assets, lean his business, lean himself personally, essentially. And it just really didn't really feel like it was a fit for him. And he wanted faster access to funds. He wanted more control over the money. And he wanted to keep earning and growing his wealth at the same time, but he just couldn't quite make it work with the business financing. So with infinite banking, here's what we did. So this is what we did. So 3 years prior to this, so to when I talked to him last to get his update. So we started the policy. So keep in mind, this is long-term focus, right? So he thought long-term, hey, I'm going to be doing this kind of stuff. I don't have to buy the truck and that kind of stuff right away. I can give it, a couple of years, 3 years. So that's what he did. So he said, hey, I want to start this thing, infinite banking. And he said, let's do an annual premium of $50,000 per year. Of that 50,000 going into this thing, because he wanted to have that death benefit for the business, for his, he had a partner in the business, but he also wanted the cash value. So of the amount going in, so he had 35,000 of his premium going towards the paid up additions. So he's building this rapid cash value. But by year three, he had accumulated $135,000 of cash value. So he'd already grown this thing up to that amount, and it was still earning him dividends. So then he took action when he was ready to buy the equipment. So he went to his policy, took a loan of $120,000 to buy the equipment outright. So he bought it with pure cash. So he got better deals with cash, and he's able to negotiate, and he had title to the equipment, not the bank. He had title. The insurance company, so for the loan, it was 5%, I believe, on his loan. It was about 5% or 5.01%, something like that, and simple interest. But here's the thing. While he borrowed that money to go get the equipment, he still earned the same dividends. Policy still was growing, still had all the death benefits. And then he was able to structure the loan payments back to his policy however he wanted. And so he did it for $2,300 per month, which was the same amount the bank was going to have him pay back to them. But he's in control of this loan, so he can choose when and how to pay that back. If he doesn't want to make a payment this month, he doesn't have to. So by being the bank in his business, he's controlling his cash flow, which allows him to grow and scale the business very strategically. So that's what he did, grew that business, very happy with that. So some of the implications on the tax side of it, because once again, taxes when you're a business owner, big deal, to be honest. So the loans, that's not considered income to him or the business. So he was able to not be taxed on that. He was able to write off the purchase of the equipment as a business expense. And also the interest he's paying was able to, for him, was a deduction. But he kept all that stuff inside of his own business in control. So pretty cool how he did that. But the results was that he avoided $24,000 of interest paid to the bank, which is a lot of interest, by the way. So can he use the $24,000 of interest that would have gone to the bank? Can he use it better in his own life and his business? Absolutely, of course he can. He also retained full control of his repayment schedule so he can pay it back however he wants. The equipment, fully owned by him. So that's a big part of this. No liens, nothing like that. His policy, so it still grew at the exact same time. Cash value was untouched, still growing. And then he had an internal financing model that he could repeat. So as he's growing his business, because he's younger, I guess I would say, he's got another 20, 30 years that he wants to do this potentially, but he can now use this policy to keep growing that business repeatedly throughout the following, years. So that's how you can use it as a business owner. That's how he did that. So another example I want to show here is how a family can use a infinite banking to pay for college. So I went to college, went into debt to do that. I did not really enjoy that experience going into debt. Took a long time, about 15 years or so, to pay off all that bad debt for the student loans. I just didn't know any better way though. But so I've helped a lot of clients set up policies just for college as a purpose to instead of a 520, 529? Yeah, the 529 plans. So I have a client right now, not yet approved, but they're doing the same thing. So they have a 529 for their son. They're going to move the funds around and fund a policy, realizing it's going to be a lot better long term than what they were originally doing. So this is Sarah and Jason in Colorado. Have about 180,000 annual income in the household. That's two incomes, by the way. Two kids, Emily and Luke, 17 and 18, and they're clients obviously through our team. And their biggest concern was massive student debt because both the parents had student debt from when they went to college. They didn't want to have their kids go through the same experience because it was not beneficial to them. They also wanted to maintain flexibility of the money in case their kids don't want to go to college. Because, like on my daughter, she's 16 now. She does not want to go to college. She has other dreams and things that I'm going to help her do through infinite banking, but it's not going to college. So if you have like a 529, something like that, and your kids don't go to college, then you're kind of stuck a little bit, and there's going to be consequences. So yeah, they didn't want to deal with that. So the problem was, so rising tuition, it was rising very fast. The markets were very, very volatile, and they were pretty uneasy about that 529 plan and what it would mean for their kids. Also, these are some things that they started to realize when they were looking at different options. The 529, they have no control over how the funds are, invested, that kind of stuff, or used. They have limited control, I should say. There's potential tax penalties if the kids don't go to college. The funds are exposed to the market's ups and downs, the volatility, right? They want to keep their money growing safely. They wanted flexibility based upon their kids choose something different. And they didn't really want to saddle their kids with debt that could come after them. So here's what we did. So prior to when the kids were going to go to college, so this is about 5 years prior, we went ahead and set up a high value, cash value life insurance policy. We did it on Jason himself, not on his kids. Keep that in mind. And he wanted to put in 30,000 per year, of which 22,000 of that went to the paid up additions, which funds the cash value. And I believe this was for both of the kids. I think it was for both the kids. And after 5 years, they built it up to about $115,000 of cash value. Now, when it came time to go to college, so Emily chose a state university. So total out of pocket for just 1 year, which blows me away, by the way, was 28 grand. So instead of loans to a bank or the government, they went and took out a policy loan for dorm and tuition costs. The interest rate was 5%, and they structured a voluntary payment back on that they did it at $2,500 per month for 12 months. That's how they were going to pay it back. Now, by the way, this is the parents paying the loan back, not the student. Okay. They can structure it more than one way. They could structure it so that after Emily graduates from college, then she can pay back the loans, as an example. The ongoing one is for Luke when he goes to college because they're paying back the policy loans now. They can then fund the college for Luke, doing the same policy, and then just managing the paybacks however it makes sense based upon the kids after they graduate. So the results were this. So they took out the loans. They avoided any kind of government loans, that kind of stuff. Also, they avoided tapping into their home equity. That was a big thing for them because they were going to tap into their equity of the home via HELOC, home equity line of credit. They chose not to because they had the policy in place, which was a big thing for them. They maintained control. They didn't have any FSA restrictions on any of the kind of the monies, that kind of stuff. But their policies continued to grow to earn dividends on the cash value, even when they were spending, or not spending, but they were borrowing from it to pay for the college. And then if Emily doesn't finish college, I don't know if she finished it or not yet. Do the math. She's probably still in college. If she didn't finish college, they could redirect those monies to other things. Maybe it's for her, maybe it's for them, doesn't really matter. No penalties. And then also the big catch, this is the big thing that when I was talking to them, that I emphasized is teach your kids how to be a good banker, because if they're going to be involved in this strategy when they're going to college, make sure they understand how this thing works so that when they graduate college and they go get their first career or job out in corporate America and they're presented with that thing called a 401k, maybe they'll choose to not do a 401k and maybe do infinite banking because it might make more sense to them. So that was one thing I know they were working on the last time I spoke to them. But that's how you can use something for a very specific purpose, like obviously paying for kids' college. Let's go ahead and use this one. I want to go through this one. This is how an average family how they use infinite banking to eliminate consumer debt and take back control. Now, why I like this one is because that consumer debt is, gosh, it's such an anchor. It destroys wealth so much, and it does not give you control. So this family was all about getting rid of their bad debt and then getting control of their money so they can start actually building some wealth. So this is Chris and Jennifer. They're in Phoenix, and total income around 120 or 110K per year, teacher, and then obviously Chris is a firefighter. Now, before they had infinite banking in place, their debts, they had two car loans at 32,000, right around 6.5% for those. They had some credit cards, 18,000 across three of those, anywhere from 18 to 24%. That's just disastrous right there. And then their monthly payments going to those debts was around 1,100 to 1,200 per month. So the problem was this, though. This is the problem for a lot of families. High monthly payments, little principal reduction. So they're paying all this money month after month, year after year, but the balances just do not seem to be dropping. They were saying that, their savings, they couldn't build any savings because all their cash coming in is going right back out the door to debt. Very overwhelmed. And I've been in this situation before. Maybe you've been there before as well. Just working to stay afloat is not a very good motivator to work hard, to be honest. So they just were like, just tired of the situation. They wanted to get rid of their debts. They didn't want to blow through all their savings. They had a little bit of savings, not very much. They didn't want to be losing money to the banks continuously, and they wanted something for the future while getting out of this hole that they had dug for themselves. So here's what we did for them. Here's what I did for them. Policy. So we did a whole life policy. We did a 24,000 per year premium. To be honest, it was a stretch for them. It was a stretch, but they directed some funds going from a retirement account because they were overfunding all of these other accounts at the exact same time they were drowning in debt, which by the way makes no sense. So they were going to temporarily reduce the money going into the retirement funds and move that over to infinite banking. So within 2 years, they had built up a $36,000 cash value policy, which is pretty awesome. They were pretty excited about that. And so debt reduction execution. So year three, so they took a loan. And by the way, this is they were doing this in the first couple of years, but in year three, the way we looked at it and summarized it, let's just assume they took a loan of 35,000 at year three, beginning of year three, by the way. They paid off all their debts. Now they were doing some stuff with the debt before year three, by the way, but I want to keep it simple for this example. So no debts anymore. So they paid it off with their policy loan. The debts are not on their credit report anymore. That's a big part of infinite banking is it's not on your credit report. Those loans are not. They took the previous payment of 11,000 or sorry, 1,150 and they put that back into their policy loan. They also, by the way, their cash flow had gone up over the prior 2 years, so they added an additional $200 per month to that loan payback to get that loan paid down even faster. So here's the result. So loan repayment was scheduled for about 3 years to pay back that loan. They were using the same dollars they were already sending to the banks, right? But now they redirected those funds back to their own policy loan, their own banking system. So I want you to understand here is that their cash flow didn't really change. What they changed was where it goes first. As we all talk about here with infinite banking, pay yourself first. Law number one, or rule number one. So that's what they did. Cash flow, once again, did not change, but the debt did change drastically. And then also by being their own bank and recapturing the debts, they were able to maintain the flexibility of the payments because if they have a tight month, don't make a payment back on your policy loan. You have that flexibility. Very cool thing right there. So for them, fast forward, 3 years, their debt is forecasted to be all gone, and they're going to have, I think it was like over $50,000 of cash value inside this policy. Actually, no, more than that, but quite a bit more than that. After it's all said and done, and now they can start putting that money to work building assets. So that was their whole strategy: get rid of the bad debt first, recoup the money back through the policy, and then put it to work building assets and building cash flow. So that's what they did. So it took them about 5 years, by the way, to do all this. So they eliminated about $12,000 in interest that would have been paid out. They now did not pay that out. They actually recaptured all of that. We did the math on it. They paid their debt back. Actually, it's about more like 5 years, but I wanted to be conservative. About 3 years faster, they paid it. They built about 40 plus thousand. So we have about 50,000, a little bit more than 50, actually, all said and done, in cash value at the exact same time. They actually, this is what they're planning on doing. This is about a couple years ago, but they're going to use the policy for a down payment on a small rental property. So once again, putting that money to work for them. That was their overall plan. And the biggest thing, though, the feedback I got is they completely changed the way they think about money. So when you think differently about money, you can take different steps or different actions and get different results. And that's exactly what they did. So here it is right there. I mean, you can look at the math. So I did some visuals to show you how it works. So once again, traditional debts, they would have paid, 17 grand in interest, total of $67,000 they would have paid out, and it would have taken them about 5 years. With infinite banking, total interest paid, this is pretty drastic, was about 1,700. They paid a lot less interest. Total payments back were about 36,000, so almost half of the amount prior. And then it took them about 2.5, 2.25 years to do it versus 5 years. So that's what they did. Yeah, we did all the math, laid it out, and they took action on it. Very, very fun. All right, the next thing I want to show you here is a real estate investor. So real estate investing is, hey, I don't have any bad debt. I want to put my money to work. How can I do this for real estate? So this is Amanda from Charlotte, North Carolina, full-time investor in real estate. She's doing fix and flips, doing rentals, things like that. Average deal size is about $80 to $150,000. I wish I lived in an area where that was the average deal size. Mine's probably more like $300 to $500,000 where I live, unfortunately. And this is a longtime student of infinite banking of our team here. So here's the problem. So doing about 3 to 4 flips a year, that's about how many I used to do as well, by the way. But she had some very big challenges with that. So she was relying upon hard money lenders at 10 to 12% rate, which is nothing wrong with that, by the way. That's what I use. And I, by the way, have still used that before. Also 2 to 3 points. And one of her bigger challenges was closing quickly. She wanted to close quickly. Traditional banks took way too long. And I'll be honest, by the way. So Amanda here, she uses her own banking system, and she also now uses private lenders as well, not just the banks, but she uses her own banking system and also private lenders. So just keep that in mind. And what she found out is when we were working together is that the profits were being eroded through all the fees, the financing fees, the hard money fees, all that kind of stuff. And she really had no system to recycle her capital that she was making from the projects and recycling them back through the next project. And it was just very inefficient, and she was very frustrated, to be honest. So once again, she wanted speed. So speed was her big thing that she was missing. And she wanted to compound her money while still staying in the market, in the real estate market, and just hadn't found a way to do that just yet. So infinite banking obviously made a lot of sense to her. So this is what we did. So we did a policy, and it was about a 50,000 per year premium. Now keep in mind, these premiums, whether they're large or small to you, they're just examples. Your numbers are your numbers. So we'll just keep that in mind. And so what we did on this, we put in 50,000 per year, and she has some flexibility in that premium. She doesn't have to put in that much if she doesn't want to. And about 70% of that was going towards the cash value. So very quick cash value growth. After about 3 years, she had about 115,000 of available cash value. And that was at the beginning, I believe, of year 3, maybe a bit more. And so what she did was, and by the way, so her next deal, this is what she did a $100,000 policy loan from her own bank, purchased a property for about $80,000. The rehab was 20K. So she kept all of this within her own banking system. She closed on that deal within 10 days. So she made the offer, had the capital, closed in 10 days. No bank underwriting, no private underwriting, no red tape. Basically, here's the cash, give me the property. That's how it worked. Now, yes, did she do her own due diligence? Absolutely, she did. So she knew this was a good deal. She sold that property 5 months later for $165,000 or $50,000 of profit because she had closing costs, all that kind of stuff. Very, very good deal for her. She was very excited about that. And she did it in 5 months. Now, my quickest deal I ever did in that space was 3 months. So 5 months, though, was still pretty good as far as speed goes. How'd she do this? So one, she recycled the capital. So she recycled her money through the policy. She repaid the loan in full plus interest. So she paid the whole thing back. Then she used the same policy again, by the way. There was no waiting period. She paid the loan back within, 10 days, borrowed it back out again. I don't know when her next deal was, but she did this, she was telling me this 3 times in a given year. So she paid a policy back, borrowed it back out again, back and forth, back and forth, back and forth. And it gave her a lot more control. But the biggest thing for her was she had a lot of certainty around her money, and certainty around it because she was the one in control. So I love that case study because real estate is goes really well with infinite banking. So once again, yeah, her results, just to summarize, she actually avoided nine to $12,000 of hard money cost, which was a big one. I didn't realize it was that high when I found that out. But she was able to keep 100% of the profit equity. She's still earning dividends, still compounding her money in the policy while she was using the money for the deal. And she's now her own private lender. But also, if she wants to lend on other deals outside of hers, she can be a private lender on other people's deals now too, which she's thinking about transitioning from being the borrower to now just being 100% the lender. But, a good deal comes across her desk. She's not going to say no to that one. There you go. But you can see the math right here. So without the infinite banking, the numbers are pretty high. So the cost per deal with hard money was about $8,000. She did 3 deals that year. I think it was 3 deals. That's $24,000, profit of 126. By being her own bank, though, it only cost her around $2,000 per deal, or a little over 6 grand for all of them. And she made $143,000 versus $126,000. So she made a lot more profit because she was being her own bank. So there you go. Now, the last one I want to mention, this is kind of a bonus one. This is a deal that I want to share with you because even though when it comes to infinite banking, being the family bank, having the family constitution as Jason teaches, there is still what we call a death benefit to life insurance. And it's not the main focus, but it is always there. And it is actually the fuel that can create this banking system, not just today, but generationally, right? So this is Dan. So Dan, he had no kids, by the way, and he was not married. So a lot of people will come to us and say, hey, Brian, why would I want to do infinite banking if I don't have any family that's going to receive the death benefit? Well, this is an example that I want to share that covers that. So he was a professional in corporate America, worked a 9 to 5 job, trading time for money. He was in his early 50s when I first met Dan, or heard about him. He's one of our clients, living paycheck to paycheck, and he was very frustrated. He had a lot of debt, or some debt, not a lot, but had some bad debt, I guess I would say. And he wanted to start investing and start doing something so that he could have a bit more in life financially. So he said, "Hey, Brian," or I think it was, I can't remember if he was working with me or worked with Mike, but he worked with both of us. But we said, "Hey, let's do a 600 per month premium because that's what he could do." And it had about a $400,000 death benefit to start with, which, by the way, he was not really concerned about the death benefit. But the biggest thing for him was, hey, let's start this and let's start to recapture the debt. So that's what we started doing. By the way, he went to a lot of our events. He went to a lot of our virtual events, in-person events. A lot of us and my colleagues had met him in person. So pretty crazy. So this is what happened though, a couple years after he started his policy. He had some crazy heart disease that he was not aware of. It did not show up in any of his medical tests or physicals, that kind of stuff. And he passed away, unfortunately. It was, obviously not what we expected. Nobody expected that. Still in his 50s, passed away. And here's the results, though, of that. So his sister was the beneficiary of his policy. And the death benefit had grown from 400,000 to right around $500,000, and that was paid out to her, to his sister, tax free. And so she actually took that money to the rest of his family, not just her. And they were able to pay off. So Dan did have some debts that stayed, and they were tied to his estate, by the way. So it was not big stuff, but they wiped out that debt. They wiped out all of her family's debt. And then another one of, I think it was his, either his brother or another relative paid off all of their debt as well. So debt was all gone. and they had quite a bit left over, and they created an emergency fund for the family and a college fund for the other family for their kids. So Dan, and he knew this could happen. Of course, it was talked about. He didn't expect it to be early in his life like this, but he was able to create this thing that really had a massive impact to the rest of the family. So yeah, so they're all glad he did it, and obviously, if he's alive, he'd be glad he did it as well. But there you go. That's what can happen. And I'll do a last one here if you guys want to hop on, stay on for another couple minutes. So this is another one that's very unique in how you can do infinite banking, and this is for some business partners. So this is Jeff and Alan, and they had a business. I don't, oh, a law firm. That's what it was called, boutique law firm in Nashville. The value of the firm, they estimated the value at 2.5 million. Now, Jeff and Alan, they were the main, I guess, call it, what do you call those? Just I guess attorneys in the office. They had some other ones, but they were the main people that were the drivers of this business. If something happened to Jeff or something happened to Alan, yeah, partners, thanks, David. I don't know why I was blanking on that. It says it right up there at the top. But yeah, so if something happened to one of them, what would happen to the business? Well, it would have a very, very challenging time continue because you lost essentially a key person called key employee, by the way, or key owner in this situation. But if something happened to, let's say, Alan, then all of a sudden Alan's estate or his beneficiaries or his relatives, his family is going to have to take over and figure out what do we do with the 50% of this business that we now own or Alan's estate now owns. You don't want to do that, by the way, because Jeff does not want to go into a business with Alan's family. And maybe if he knows them well or something, yes, but typically, no, you don't want to go into business with them. But what does Jeff do? Does he have the funds to buy out Jeff's or Alan's family? Okay, because let's say if it's 2.5 million of value, he might have to buy out the 50% for like $1, $2 million, something like that, a big amount. So what they did is they both got policies on each other. So Jeff has one on Alan and Alan has one on Jeff. And they're both the beneficiaries of each other's policy. So if something happens to one of them, the other one is going to receive the benefits. And there's an agreement called a buy sell. I'm not going to get into what a buy sell does contractually. An attorney has to set it up. But what happens is someone passes away, then that agreement comes into play. And it gives the other living partner the right to buy out the partner's estate so they don't have to be involved. And it's already stipulated how much it's going to be for, usually percentage wise. And the policy, the death benefit, is going to fund that buyout. That's what happens right there. It's all contractual, by the way. So that's how they have this whole thing set up. And so this is the summary of what happens right there. So if they pass away, become disabled, what happens is the business valuation is there, high valuation, but there's no liquidity. They didn't have that, by the way, in the business to buy out the other 50%. So there's a huge concern there. And by the way, a lot of people don't realize this is a problem or a challenge until somebody passes away. At that point, you're done. You can't go back and fix it. It's not retroactive, right? So these are things that if you're in business, think about these kind of things, or you want to go into business with somebody, keep these in mind. Because the surviving partner, in this case, Jeff, as the example I gave, they're both still alive, by the way. But Jeff, how could he buy out Alan's, part of the business? So what banks can do, though, they offered life insurance backed loans. That's what they can do, by the way. But that would add debt at a very bad time. So I don't know if you guys know this exists, but a bank says, hey, yeah, we'll go ahead and loan you the money to buy this out, but we're going to require you to get a policy on yourself with the bank being the beneficiary. So if something happens to you while you're alive, the bank is going to be paid out via the death benefit. They can do that, by the way. That's because they're the beneficiary. But they didn't really want to do that because there's a bank loan, there's debt. At the same time, someone's passing away. It doesn't really make sense, and they didn't like that. And then the attorneys, you have to have an attorney involved. But before they did this, they had no succession plan in place or mechanism. When I saw that, I was like, hey guys, big red flag. You have nothing in writing. You have an idea in your heads, you have a theory, but if one of you passes away, that theory goes out the window because now there's only one person aware of the theory or the idea, but nothing in writing. So that's where you have a lot of litigation, arguments, all that kind of stuff. You want to avoid all that in business. So once again, their goal was a contractually enforceable buy-sell agreement. That's what they wanted. Keep control of the firm in the hands of the business partner that's remaining alive, of course, and avoid all the debt, avoid a forced liquidation. By the way, I have been through that by a forced liquidation. It's very unsettling, by the way. It's where you're forced to sell a business that you don't want to, or you're forced to sell assets that you don't want to, but financially you don't have a choice because nothing was set up ahead of time. Yeah, so the policy was this. So they each got a whole life policy on the other one, like I mentioned. Face value or death benefit was 1.25 million. By the way, that's 50% of the firm's value. Now, I'm going to pause here for a second because you might be thinking, well, Brian, if the value is currently right now 2.5, what if it goes up to 5 million? Okay. Well, keep in mind with infinite banking, your death benefit is always going up. Okay, so it's always going up. The other thing is that knowing the business is going to go up in value and knowing that we might want to get more coverage down the road because of the increased value, we also want to lock in the insurability of the both partners. Because what if one of them has cancer and can't get a policy, but they need to? Well, you can do what's called a term conversion policy. So as the value of the business goes up, we also locked in term insurance at the very beginning, in addition to the whole life policies. Why do we do that? The term policy for 10 years, maybe it's $2 million of death benefit. That term policy guarantees your insurability for the 10 years of the term policy, and you can convert the term insurance to whole life insurance with no qualifications. So we did this for them because now they have locked in today the value of the business and they can get more death benefit coverage over the next 10 years because of how we built these policies. So a lot of options there. They did it with 18,000 annualized premiums each for each of them, by the way. The business did fund that. They did it via post-tax dollars, not pre-tax, but post-tax dollars, by the way, for specific purposes. And then it had obviously high early cash value and long-term protection. So this got rid of all of their concerns, got rid of their fears, and made sure both families were very comfortable with the business, and they could just focus now on running the business, being successful, and not being so worried about what happens if. And oh, by the way, on this one, we did have the policies own. No, the business owned the policies, I believe, and was the beneficiary. But I think overall, long term, they were going to move the policies into a trust that is owned by the business. I can't remember. It's an attorney question, but they did have an attorney do all of this and made sure it was done correctly. But they did also they had a legally binding contract. The buy sell agreement was signed. And so if one partner dies, policy pays out. It stipulates what happens. And so you've got to make sure you have that in writing. And then the buy sell agreement says that, hey, you have to use, or the firm, the remaining partner has to use the death benefit to buy out the deceased partner's shares. Like it said that you have to do that. You can't just take the money and run, as an example. But yeah, surviving partner retains full ownership, and there we go. So that is how you can do that. But the other main benefit of why they also want to do this is that the cash value grows tax free, by the way. Tax deferred, sometimes we say that, but in this case, tax free. And then they can use the policy loans over the following years to actually grow the business and also fund retirement. So the kind of the third or fourth or even fifth phase of this whole strategy was retirement. So assuming nobody dies, which obviously that's what we want, then the policies down the road can then be utilized and transferred over to the partners, and they can use them for retirement for a cash flow. So it's not just one thing or solving one thing. This solves things today, like what's the challenge today, and also what are challenges that we might experience over the following 5, 10, 20, 30 years. Infinite banking can help solve all of those things. So that's part of why I love infinite banking, is because it's very versatile. It can be used today, tomorrow, down the road. It can solve more than just one thing. And I mean, oftentimes I always tell people, I say infinite banking might solve a problem that you have not even thought of yet, which is very cool, by the way, because hey, this thing might happen down the road. We don't know what it is, but infinite banking might be the thing that comes in and saves the day. And I say that from experience. I've had people that have had policies for 20 years, and they've told me stories about how they've used these things for unknown or unforeseen events, and they are so freaking grateful they have infinite banking in place, that they learned about it, because otherwise they would be up the creek. So guys, so that's just like a few examples of how people that I personally worked with have used infinite banking. Hope that makes sense. Oh my God, I got so many slides on these things. Um, Yeah, so this is kind of what they did right here, but I'm not going to go through all these. But yeah, it's pretty amazing how they've done this. And I can think of so many examples of how I've set up infinite banking for people. Bottom line is that when you are looking to do infinite banking or anything like this, find someone that has some experience, that has quite a few clients, by the way. We do. Jason, of course, obviously has lots of clients, because we're going to be able to think of things that you might not think about, or think of situations or solutions or just strategies that that we've experienced or we have clients that experience that we can apply to your situation. All right. Well, with that, everybody, thank you all for being here. Thank you all for attending. And with that, hopefully I will see some of you in the future. Take care, everybody.